Good morning. We will wait for a minute or two so other colleagues can join us. I see that people are joining us, so let's just wait for another 30 seconds or so. Numbers are going on constantly, so let's wait a bit. Oh, my hair is all right.
What about mine?
Yeah, we are both perfect. Numbers are still going up. I see that there is a lot of interest on this topic, so I'm looking forward to see how many questions we'll have in the Q&A after this, because I bet that it will be a lot. So good morning and welcome to our webinars today, Exporting to the EU in 2026, and we'll focus on the VAT changes and Regime 42. This is a picture of mine, and this is me. My name is Malin Janofu, and I work as Business Development Manager, International Trade at Thames Valley Chamber of Commerce. If you never heard about Thames Valley Chamber of Commerce, we are the accredited chamber covering Berkshire, South Bucks, Oxfordshire, Swindon, and Heathrow. Before we start, I would just like to state that today's session is being recorded, and a recording of the session will be made available on our website, thamesvalleychamber.co.uk. If you have any questions, please send them using the Q&A facility and we will cover most of them, hopefully all of them. And if we won't manage to cover all of them today, we will send you an email with an answer. My area of expertise is not VAT, so I prefer to leave this to an expert, Alessio Lencioni, who is the head of supply chain at VAT Stream, and he can explain to you a lot more and a lot better about VAT. Thank you for coming, Alessio, and please.
Fantastic. Malin, thank you very much for the introduction and good morning to everyone. So just to give you a bit of an introduction while I now try to share my screen. So as Malin mentioned, my name is Alessio and my background is in supply chain and logistics. A key focus of mine over the last few years has more specifically become that of import VAT specifically. And the reason for that has specifically been around the focus on import VAT post Brexit, which has become a core focus of our business. And I can't believe that still, call it 5-6 years on, it's still such a term that is front of mind for so many British businesses and UK-based businesses. But alas, I think the reason why it's still become a very nuanced and focused on topic for a lot of exporters is purely because there's so much misinformation and changing of goalposts in terms of how the solution can be managed and ultimately should be managed. So one of the key focuses that our business focuses on is market entry into areas such as this, and that's why in conversations that Malin and Alfie and myself have had has been around how do we better inform British businesses about the requirements when moving into markets such as Europe that are highly regulated, but also very business friendly. And it's about finding that balance of the two, specifically around the notion of VAT. So thank you very much again. So in terms of today, we're going to cover 5 primary topics. The first is going to be ultimately what import VAT actually is. Now, At the end of all of this, we will go through a Q&A. So if I can just ask everyone to hold their questions off till the end. But the reason why I want to start with an introduction to import VAT is because we need to understand the nuances of it. And I apologize if some of you are more up to speed than others. It will just be a very high-level overview just to give everyone significant context. The second aspect will be to look at a practical real-world scenario. And this is that I find it's easier for businesses to draw comparisons to a real-world scenario within their own context. Then the third point will be to look at the differentiation between B2B sales and B2C sales, and how both import VAT and sales VAT, and that's an important distinction that we need to make, are handled differently. Then the fourth point will be looking at the changes that are of the most prominence in 2026. And the last point will be to look at the key risk areas and how to reduce your exposure if you are at risk. So I think let's ultimately start off and try and understand why VAT is such a critical point and still such a contentious point for so many businesses. And I think it's important to understand that VAT is an obligation, whether you're making the sales of goods or services in Europe, but there are nuances in terms of how it is ultimately applied. And although many businesses have gone for an ostrich approach in terms of putting their head in the ground and waiting to see what happens, unfortunately, it is something that we are seeing time and time again, in that it is becoming of greater significance. And it's not necessarily going to be something that goes away. If anything, it's going to be something that becomes more robust and more structured, that requires better processes in order to be actually to be better prepared to handle these challenges. And lastly, it is a big cash flow burden on many businesses if not managed correctly. So now let's look at the distinction of what import VAT is. So for many UK businesses, import VAT is something that is charged on the importation of goods or services if they are procuring it from countries abroad. And many of us that are importers into the UK know that we can benefit from PVA. So in many instances, we're not actually paying over that import VAT if we've got our structures done correctly. But when exporting to other markets, such as the EU, and we're facilitating that on an Incoterm that is DDP, which is becoming of greater prominence in the European market, import VAT again becomes something that we are incurring. Now, import VAT, if you are a local business in Europe or a private individual and you are importing goods, is something that you incur for purchases that you're making, or if you're the seller, it is something that you have to account for and potentially on charge to your clients if you're making sales in said country. Now, all imports into Europe have an import VAT applied to it in some way, shape, or form within the lifespan of its transaction. You might be shielded from it by a supplier or a merchant of some sort. But basically, businesses in Europe that are making the final sale onto consumers are the actual companies that are charging VAT for final consumption. So they are ultimately the ones that are collecting that VAT at final sale in Europe. So the reason why this is quite important is that we need to remember that when goods cross borders, VAT rules change significantly, and it's not something that will go away. So as mentioned right at the beginning of our introduction, we spoke about how VAT has become more complex post-Brexit. And because the UK is now treated as a non-EU country, it means that all exports from the UK going into Europe have import VAT applied at the border, at the customs clearance stage. So therefore, detailed and full customs declarations are mandatory. And the VAT responsibility needs to be clearly defined. And this is very, very closely linked to the Incoterm used and who's ultimately acting as the importer of record. And so because our goods are no longer considered intra-European in terms of how they move, the handling of VAT is no longer automatic. It needs to be something that we need to factor in. So ultimately, what are the scenarios that VAT applies to a UK business doing business in the EU? So it will as we've mentioned, when goods are imported into the EU, import VAT will apply. When goods are stored in the EU, certain countries in Europe have differing legislation and rules around storage. But the long and short of it is that they've all got minimum time spans. If you are making use of a 3PL in Europe and your goods are being stored on a shelf or in a data center or are being utilized on some form of hiring purpose, those goods have a minimum a minimum time window that they can be stored in Europe that you do not need to register for VAT. And that would just be an ordinary VAT registration. If you're facilitating the sale of goods or services and you're making the final sale to an EU customer, then there would be a sales VAT component. And if you're acting as the importer of record, and again, if you're selling goods on a delivered duty paid basis, you will incur the cost of VAT or the liability of VAT. And that's an important distinction that we'll cover now and differentiate between. But the long and short of it is that even without a physical EU presence, VAT obligations still arise and you are still liable for it, even though you're not a local European business. So if we go into slightly more granular aspects of import VAT is charged at the local rate of the country of customs clearance, so where the entry is taking place into the European Union. So what we'll see is in France, there will be an import VAT rate of 19%, the Netherlands 21%, actually I think France is 20%, I stand to correction there. But every European country has its own independent import VAT rate that is applied when you're importing goods into that country. And the obligation to pay import VAT becomes obligatory at the customs clearance point. So once your goods are at the border, depending on the Incoterm that you've utilized, if you've shipped DDP, your carrier has collected it from you at the onset in your conclusive price. If you are shipping goods on a DAP basis, when your goods get to the border, or even if on a DDU basis, once your goods get to the border, the clearing agent that's been appointed will contact you and say, please, we need these duties and this VAT to be paid over in order for customs clearance to take effect. Now, import VAT, as you can imagine, and if we look at the short example that we've got on the right-hand side here, can be a significant cash flow impedance for businesses. If you are a business that is importing goods, let's say from the UK to the Netherlands, and the value of those goods are commercial value of 100,000 euros, the 21% import VAT rate on the importation of those goods into Europe will result in you incurring 21,000 euros of import VAT. Now, if you haven't managed your structures correctly and without the correct planning, that 21,000 euros becomes a cost, and a sunken cost, as many businesses refer to it as. Because if you are facilitating the sale of goods, import VAT should always be recoverable. And that's a very important point I want to cover on today. And we'll touch on that when we speak about Regime 42 a little bit later, and why the significance of that is so important. But it's important to recognize that if you are making sales in Europe, import VAT should always be recoverable in some way, shape, or form with a correct structure. So to touch on this a little bit further, and it's because it's imperative to understand, but the Incoterm responsibility around who pays for VAT is vitally important. And it's very closely linked to the importer of record. So if you are shipping goods on a DAP basis and your customer is the importer of record, then they will be the ones responsible for the payment of VAT and who will then ultimately be able to reclaim the VAT. If you're shipping goods DDP and your client is acting as the importer of record, you are ultimately paying over the VAT, but your client, who's the importer of record, will be the one that is able to reclaim that VAT. Now, on a DDU basis, your client, again, similar to DAP, but the difference is you appointing the broker. Your client will act as the importer of record, and they are also the one paying the import VAT. Now, the distinction of this is very important, and specifically around a DDP scenario. If you are paying the VAT and duties, and specifically the import VAT, but you are not the importer of record, your import VAT is essentially lost unless you are building in that import cost, that import VAT cost into the overall price of your product. But commercially, that wouldn't be very clever because it's an additional cost that makes your product less competitive within the local market. Because if you are making business-to-business sales, or even specifically within a business-to-business context, the import VAT should be able to be nullified, because sales VAT from businesses to businesses in Europe are also nullified utilizing a structure called the reverse charge, which is something we'll touch on shortly. Now, you also have a responsibility for VAT if you have a local VAT registration and you're making sales within Europe. There's a component of liability that you have to take on depending on the scenario, and also depending on the customs regime used. So, for example, this touches very closely on regime 42 or CPC 4200, which is what many businesses were using for a number of years to clear their goods into Europe via France. And that's something we'll touch on. So the reason why I want to put significance on this is we see a number of businesses in our world come to us and say, but I thought my courier or my freight forwarder was handling the VAT. You might be paying it over to them on a DDP basis, but you're not necessarily handling the compliance at the destination side of the transaction. And secondarily to that, it's important to realize that couriers and freight forwarders are very good at moving and clearing goods. That's their core function. But they do not take the VAT liability, and they are not specialists in VAT. And that's why we see a lot of the issues that we see. So it's important to understand and recognize that there are ways to optimize the VAT requirements that businesses have to fulfill when shipping into the EU. There are mechanisms such as VAT deferments, which basically means that with a correct structure in place, a business does not have to actually pay import VAT for the movement of their goods into Europe if they are making some form of taxable sale, whether it's on a B2B perspective or a B2C perspective, utilizing the correct customs regimes, such as regime 40, which is something more commonly used by many businesses. Or likewise, if a business is using the correct importer structures, so they have their own VAT registration and they have their own importers code registration. They're utilizing some form of centralized VAT reporting, so that they're working with a fiscal representative potentially to help them consolidate all their paperwork in the most effective and efficient way. And largely, something that I think we all cannot ignore in today's day and age is having some form of technology-driven visibility to manage the movement of VAT and how that correlates to the actual movement of our goods. The two need to be correlated and linked, because if we are not, we are asking for impending disaster. So it's an important distinction that the key to all of this is we need to plan before a shipment moves, because once a shipment is moved and customs clearance has taken place, if the correct procedures are not in place, it makes it either near impossible or completely impossible to reclaim back any form of VAT that has been incurred. So if we're going to look at one practical example, there's a client by the name of Nova Strength. It's a fictitious name for an existing client of ours that we work very closely with. And on a practical example, they import goods into the Netherlands. So when they started working with us about 3 years ago, it was a bit of a humdrum mess in terms of how things were ultimately being facilitated. So goods were being imported into the Netherlands, whereby their client was acting as the importer, and the import VAT payable at clearance was ultimately being fitted by Nova Strength themselves. So their client was acting as the importer of record. The client was the one that was not having to pay over that import VAT, because what Nova Strength was doing is that they were actually building it into the cost of their goods that they were sending over to Europe. But what Coreform Health, their client, was doing is they were actually claiming back that import VAT because they were the importers of record. So the only person that was left out of pocket was actually Nova Strength. So if we look at this, if they were shipping goods of 100,000 euros into Europe and there was a 21% import VAT being applied to the importation of these goods, 21,000 euros was being reclaimed by Coreform Health because they were the importer. But Nova Strength was actually paying that 21,000 euros theoretically over and giving them a double discount if you can really consolidate it in such a specific way. Now, the issue also here was that in many ways, because of how the shipment was being structured, there were delays in terms of how the shipment was also being facilitated logistically. Because the VAT was not paid up front, once the goods got to the border, they were doing a DAP with clearance model. The broker would reach out to them and say, please pay over the import VAT. They were not aware that if they moved it on a DDP basis, they could have incorporated all of that cost right from inception and have had a better idea to be more proactive in terms of how the clearance process could work. Thirdly, the VAT reclaim for Coreform was also taking a significant amount of time because they were outlaying that money that was built into the actual shipment cost, and then they were having to reclaim it back. So there's all these nuances from a landed cost perspective that Nova Strength wasn't really able to really get a grasp of. And there was also an administrative burden on the client where Coreform eventually said, like, this actually just isn't working for us. So that's where Nova Strength ultimately reached out to us, and we started to unpack the issue that they ultimately had that wasn't working for them commercially, and from an administrative perspective wasn't working for their client. Their client was opting to actually rather look at sourcing these goods locally within the EU, which Nova Strength naturally did not like. So what was the solution that we put in for them? So what we did for Nova Strength is we actually got them their own importers code set up in the Netherlands. So we got Nova Strength a Dutch EORI number set up that is linked to the UK entity itself. So they didn't have to set up a physical entity in Europe or anything to that effect, but it allowed Nova Strength to act as the exporter of record out of Europe, as well as the importer of record. It allowed Nova Strength, to act as the exporter of record out of the UK and the importer of record into Europe. What we then also did is we got them a Dutch VAT registration, again, without actually having to set up a physical entity in the Netherlands. So they don't have a BV number, a business registration number, or anything to that effect. But they've got an importer's code and a VAT registration that are connected together. In addition to the import VAT registration, we also got them a VAT deferment, which is like, if you can call it, a bolt-on to their VAT registration, which allowed them to basically pay zero import VAT on their goods going into Europe. So what was the overarching impact of this is that Nova Strength was not paying any import VAT at the border, even though they were the importer of record. They facilitated all their shipments on a DDP basis. VAT was declared and basically reclaimed on the same VAT return because it was zero rated on import, and the net payable amount was therefore €0. Now, the benefit for both Nova Strength as well as for Coreform is that there was no upfront VAT payment. So now Coreform no longer has that obligation of acting as the importer of record, nor the risk. There was a faster customs clearance process because the goods were delivered duty paid from origin. There was a pre-clearance done on the goods at the border, so they already knew that the VAT amounts were there, all the paperwork was there, it flowed seamlessly through border control. There were significantly improved cash flow benefits for Nova Strength because they weren't outlaying all this money and not recovering it, and they were fully compliant with the Dutch taxation laws. But more importantly, both for Nova Strength and for Coreform Health, is that they knew what the ultimate landed costs were when they were actually placing the order. For Coreform as well, it lowered their cash flow outflow as well, because they weren't now having to reclaim 21,000 euros worth of VAT, that utilizing the structure, because Nova Strength has their own VAT registration, and they were invoicing Coreform, which is also a Dutch-based business, with zero VAT, because, as mentioned, there's the concept of reverse charge, which basically means that in the European Union, if one VAT registered business makes taxable sales to another VAT registered business, no VAT has to theoretically be paid over between the two companies on the transaction. It just needs to be accounted for on the invoice and submitted by the buying company in their VAT registration or in their VAT filing. So it becomes a very cash flow efficient transaction for all parties involved. So therefore, VAT is accounted for. It becomes an accounting exercise and not a payment exercise, because it's not actually having to be funded by the businesses involved in the transaction. So what are the common mistakes that we see here? So we see that many businesses believe that VAT is only applicable on sales, which is a half truth. Again, not understanding those import responsibilities, shipping DDP without a VAT registration, and paying that VAT upfront unnecessarily when there are mechanisms in place, as we've learned, to ultimately be able to reclaim it or defer it. And linking your responsibility to your courier is dangerous in the fact that they work independently of each other. So you need to have good data capturing and data management abilities to be able to facilitate all of this correctly. So therefore, these are all avoidable mistakes that many businesses make. But ultimately, one of my favorite sayings, and it might not be the most elegant phrasing in the world, is that you don't know what you don't know. And unfortunately, for many businesses, that is a reality and a truth. But that's why we are having this discussion and conversation today. Now, I imagine some businesses here might ultimately facilitate B2B sales, and others might facilitate B2C, or some facilitate both. But in the context of these transaction types, there are a lot of similarities. I would say more similarities than differences. But in terms of how we handle the outputs, the sales VAT component is slightly different. So between these two transaction types, you'll see with a business-to-business transaction, a VAT-registered business with an EU VAT number in most instances is the buyer of the goods. Secondarily, in a B2C transaction, there's an ultimate private individual that has no VAT registration, that cannot have a VAT registration, that is the ultimate buyer. So who ultimately pays that sales VAT? Well, in a business perspective, as we learned about, a reverse charge applies 0% to the VAT value of an invoice. So therefore, if it's a business-to-business transaction, the short answer is that there is no sales VAT that is basically applied to it if it's a VAT-registered buyer. On a B2C perspective, because VAT is a consumption tax, whereby the ultimate consumer is the payer of the VAT, VAT must be charged at the country rate of destination. So if you are making taxable sales, even though you're based in the Netherlands with a VAT registration, to a private individual based in, let's say, Portugal, you'll have to charge Portuguese VAT on that end sale because it's the final place of supply. Now, who accounts for VAT? So on a B2B perspective, the buyer always accounts for the reverse charge in their VAT return. So if I am buying goods from another VAT registered business in Europe and they haven't charged me VAT, I have to account for it in my purchases in my VAT return. On a B2C perspective, the seller must account for the VAT because what they are theoretically doing is collecting the VAT on the government's behalf, which they then pay over to the tax office. Now, we speak about a one-stop shop. Now, a one-stop shop, or an OSS, is a specific structure that helps B2C sellers in Europe. And the reason why this is important is we spoke about the example of making taxable sales into Portugal. You would now have to ask the question, well, if I'm making taxable sales into Portugal, does that mean now I need a a Portuguese VAT registration because I've collected Portuguese VAT and I need to pay it over to the Portuguese government. No, that's the short answer. An OSS allows you to unify all of your taxable sales and the VAT collected from those taxable sales on a B2C perspective under one localized and unified filing through the host country of your VAT registration. So what that means is that if I'm collecting VAT for sales that I've made into Portugal, into Italy, into Poland, into Lithuania, into Austria, into France, I'm collecting all of the sales VAT at different rates. And what do I now ultimately do with it? Well, you would file that in your OSS filing, and all that money that you've collected from those taxable sales, you would pay that over to the Dutch tax office in the specific scenario. And the Dutch tax office, with all the supplementary information of the sales invoices that you've submitted with your filing submission, they would then ultimately go from a tax office perspective and say, company A with a Dutch VAT registration has made 10 taxable sales in this quarter to Portuguese end consumers. Portuguese tax office, here is your allotment of VAT. French tax office, here is your allotment. Italy, here is yours. Poland, here is yours. Lithuania, here is yours. So it takes the liability of the actual payment facilitation of that VAT over to the tax office to a tax office level. So the tax offices are remitting it across each other and just simplifying the flow of money across the union. Now, from a customs clearance structure perspective, on a B2B perspective, we see many businesses ship things on a DAP or DDP basis, depending on who is VAT registered and where the liability ultimately needs to sit in the transaction. But that is the often utilized Incoterms that we see now across Europe. On a B2C perspective, I think such is the nature of transactions that many end consumers don't want or don't know how to be involved in the import context of importing goods and the admin associated with that. So most transactions that we see on a B2C perspective for goods coming into Europe are done on a DDP basis. And this is either done through a VAT registration with an OSS or an IOSS. Now, our IOSS, I must make mention, is going to start falling away in the next 18 months, purely because it's specifically structured around low-value goods. So goods with a value of less than, I believe it's 150 euros. I stand to correction on that exact grouping. But on the notion of 150 euros, if your goods are under that threshold, you would utilize an IOSS structure to clear the goods. However, and we'll touch on why that structure is falling away, but it's largely got to do with the influx of low-value imports from the Far East that are clogging up the customs system and the customs processes across tax offices within Europe. Then lastly, we're going to look at the overarching compliance complexity. Now, if you are facilitating business-to-business sales, you only have to worry about your VAT, your primary VAT registration that you need to facilitate those filings for. Now, if as mentioned, all the structures are there and it's very simple to facilitate, arguably B2B transactions might seem similar to B2C transactions. But again, B2C transactions, although might at face value seem slightly more complex, by linking your OSS and your VAT registration into one unified filing, it makes the multi-country VAT rates and reporting obligations simple to deal with and basically very similar in context to how you would facilitate your B2B transactions. So in summary, B2B is entirely VAT neutral when structured correctly. Between the combination of the reverse charge and the import VAT deferral, there is no real cash flow impact. On a B2C perspective, the VAT cost and compliance drivers is what I would say chases away many companies trying to explore this. But the seller must charge destination VAT and manage that reporting. If you are doing that, the context of how you manage your compliance into Europe is incredibly simple and incredibly straightforward. Now, a large aspect of what today's focus was on was some of the changes for 2026. And one of the largest changes that we saw come into effect at the end of 2025 and at the beginning of this year, and what's taken up a lot of my team's work, has been around the removal of Regime 42 or Customs Procedure 4242. Now, why this is very important is because Regime 42 was a structure that allowed businesses to defer the importation of import VAT, to defer the payment of importation VAT, so import VAT, by using their own EORI and a partner's global VAT number. So therefore, foreign businesses benefited from deferring import VAT without actually having to have a VAT number. So what that theoretically means is that if I was a UK exporter and I was importing goods via France, which is where the Regime 42 was most commonly and almost, I would say, primarily utilized, is that I would act as the importer of records of my goods going through the French border. But what my broker would do, or my freight agent would do, is they would have something called a global VAT number for simplification purposes. And what they would do is they would link my EORI number to their global VAT number. Now, that global VAT number was utilized and linked to thousands of other EORIs that UK and foreign-based businesses were utilizing to import their goods into Europe. Now, at face value, that might not seem as a problem, because what would happen is that because France has automatic VAT deferment, the goods would be imported. There would be no import VAT applied because there's a VAT number associated to the EORI, and the goods would then be within free circulation within Europe. And because the onward sell of goods was to another VAT registered business, and this global VAT number was being utilized, the agent or the broker would theoretically act as the merchant of record, so the seller of record on behalf of the importer in Europe. So there would be no sales VAT to the onward buying company within Europe. Now, theoretically, that all sounds fantastic. However, there was significant issues, and there were three primary issues that really created this house of cards, which then eventually came falling down in 2025. And the reason why was that there was no true VAT link between the EORI and the VAT number, because the importer never had their own VAT number that they could ultimately utilize for the import process. There was no direct link between who was ultimately, let's say, facilitating the VAT and who was the importer. But the issue was that the importer always held all the liability for the VAT. So this made a disconnect between who was acting as the importer and who was facilitating the VAT, and it became virtually impossible to track discrepancies across the board. Because what we would see in many instances is that the merchant of record, so the agent whose global VAT number was being utilized, would not necessarily file all the sales, the outward supply of invoices to the end customers for all these different businesses that they were acting on behalf of with their VAT number. So this created massive audit exposure for many of these importers, because what would now happen, because of this global VAT number that was used, the importer is now fully dependent on third parties to correctly handle these filings. So what would happen was that the French tax office would say, okay, we see that there was this import into France, but we're not seeing any outward sale. There was never an outward submission of any sale for this importation. So as soon as that happens, it raises a red flag. Because there was no outward supply, then the French government says, okay, well, then import VAT should have been applied. They then go on to facilitate an audit and say, well, who facilitated the purchase of these goods? So who was the ultimate buyer? The buyer, who could be in Austria, is either can't be contacted because they need to now go through a number of different tax offices to actually get hold of that business. So it's much easier for the tax officers to say, well, who is the importer of record? It now goes back to the poor British business that is completely unaware of them not being compliant within this whole mess. And this could be 6 to 12 months after the transaction took place and say, British business, we see you made taxable sales of 100,000 euros into Europe. Could you please pay over the 20% VAT that you owe us? Kind regards, the French tax office. So this created a massive liability for so many British businesses because they were being hit with invoice after invoice from the French tax office for taxes that they had no facility to actually now pay because it had never been factored into their costing. And there were a number of businesses that went through a lengthy legal procedure to ultimately try and devoid themselves of this. Many went bankrupt because of paying these taxes. So the decision was eventually taken towards the middle of last year to actually remove Regime 42 in totality. And what we now see is that all businesses actually have to have their own importers code and their own VAT registration, and they have to be linked to the same business in order to facilitate sales into Europe and at Europe at large. So this ultimately opens up the question that VAT visibility, or rather the statement that VAT visibility is essential. Businesses need a clear view of where VAT is incurred, how it is incurred, and is it actually being accurately incurred. And the reason why is because if it's not being accurately incurred, your documentation becomes inconsistent. And once your documentation is inconsistent, you open yourselves up to massive audit risk. And if your documentation is not done correctly and is not compliant, an audit risk can really create severe issues for businesses. So by having these 4 primary pillars resolved, you can make business into Europe so easily, and it doesn't have to be scary. And I don't want to be a fearmonger by any means, but it's just I need to raise the issue of if you don't do this properly, it can be a challenge. But if done correctly, it can revolutionize and transform your business. And this can largely be now done through technology. So tracking your VAT exposure and linking it to the supporting files that are all linked to the actual movement of the goods itself reduces your risk entirely. So if we look at some of the key takeaways, VAT is unavoidable. There's no question about that. And although we harp on about it post-Brexit, the rules have become more complex, but many businesses have overcome this and continue to overcome this. And it doesn't have to be a serious cash flow impediment on your business, but it requires you to be responsible in terms of how you do your business. And the responsibility depends on the structure that you put in place, not what you assume your partners are doing for you on your behalf. So with the right approach, VAT can be managed, it can be deferred, and in some instances, it can be recovered as well. So understanding VAT from the onset allows you to gain access to the European market. It allows you to have a much more competitive standing in the market, basically being a locally based business without all the complexities that comes with setting up a local entity and still maintaining full compliance in the market. So thank you very much. I hope many of you have seen value in what we've spoken about today. We'll now go into a brief Q&A session. Here are my details. I believe Malin will also share this pack with everyone after the webinar, but I'd be more than happy to hear some of your questions. Thank you very much.
Thank you very much. Thank you, Alessio. I learned a lot. I learned more about Regime 42, things that to be honest, I didn't know. So thank you very much for this. People are already starting to send us questions, and please continue to send us your questions to the Q&A facility. Somebody asked during your example at the beginning what Incoterm was used for that example, and I assume that was the DDP sale for your client, isn't it?
In the resolution, yes, it was a DDP Incoterm that was then ultimately utilized, correct. Previously, they were facilitating it on a DAP scenario.
I've got Uh, Very interesting question, and I noticed that this happens quite a lot in the real life. A shipment was made into France on DDP through FedEx, and of course, FedEx is now charging us the VAT in the United Kingdom. Can we claim these back?
So if you are the importer of record into France and you've got a French EORI or European EORI whereby you're acting as the importer, you can reclaim back that VAT, even if you don't have a VAT registration in place. It involves the utilization of something called the 13th directive. It is not a quick process. It is not a process I would advise businesses to undertake commercially, but it does allow you to reclaim back import VAT where you have been the importer, but you don't have a VAT registration in place and you are not a European business. Going forward, if businesses are doing this, we can then get them a VAT registration, which naturally allows them to defer that import VAT in totality.
This is amazing. Thank you. Somebody is asking if we are sharing the presentation. Yes, I can promise that either today or tomorrow we will share the presentation together with the link for today's session. So you can watch it later or you can share it with your colleagues as well. So promise I'll do that today or tomorrow once the registration, once the video is ready. And can you tell us a bit more about, because I understand that there will be an URI number in European Union for the UK company, also a VAT registration. What is the implication of the indirect representative? How it will
So
work? How it's done?
perfect. I'm reading Kevin's question here, and
Yeah,
Kevin, I
yeah.
agree with you. In many instances, indirect rep, if done incorrectly, can be a real issue because, again, ultimately it becomes a bit of a hornet's nest in terms of who's responsible for what. The long and short of it is there's two primary markets in Europe that allow for indirect rep. If we really nail it down, it's France and the Netherlands. And I can assure you that if you're working with the correct broker that is a specialist in indirect representation with an EORI and with a VAT registration, you should not experience those issues of indirect rep clearance in either one of those markets. Where it does become an issue is when you're utilizing I would say, a destination-based broker that you don't have a relationship with, and that's where the wheels start to fall off the bus. Again, Kevin, this is something that I would happily walk you through. It's something that we've done for thousands of clients on our side, and it really is doable. But you have to link the broker, the importer's code, and the VAT registration into one unified system in order for it to work seamlessly. Otherwise, you're going to have a three-wheeled car. It might work, but it won't be stable.
Thank you, Alessio. I've got one that I think I can answer this one. The question is, should we be adding VAT to B2B invoices for shipments to European Union from United Kingdom? The simple answer is no. Exports are VAT zero on the invoice. I'm very
Correct.
happy. I could answer one.
Correct.
Somebody asked,
But
but I
there
assume
is a
that
caveat in that. There is a caveat in that. It does depend on who's acting as the importer of record. So if your client is acting as the importer of record, then there will be an obligation to fulfill the payment of import VAT. Now, that then links to your Incoterm. If you are shipping a DDP, then you need to factor in the import VAT of the country of destination that the goods are then being cleared in. Or alternatively, if it's a DAP or a DDU shipment, then your client will be contacted to then fit the bill of that import VAT. So, but there will be no British VAT applied to an export sale. Correct.
what I tend to advise our customers, we do consultancy, but we are not specialized in VAT. We understand the basics of it. And I'll tell people again today, if you are not 100% sure that you understand the VAT implications, never, but never agree to a DDP Incoterm for your sales B2B to European Union. So if you are not 100% familiar with what the VAT implications are, just wait a second, don't accept the DDP term, and get all the information in place. Somebody's asking, but I assume that you won't have the news now. What will change when the IOSS has fallen away? I assume that because this will happen 18 months from now, you won't have all the details.
So the IOSS will basically just be replaced by the OSS. Now, the IOSS was basically the linking of an EORI and a VAT number into one unified structure, but you weren't allowed to use it for shipments over, it was, I actually just double check now, over 150 euros of value. So now basically formal clearance will be undertaken on all shipments, regardless of value going into Europe. And the essence of that is that you will use your VAT number and an OSS for customs clearance. That's the long and short of it.
I've got another one that is quite interesting with the special territory of France. So, exporting from United Kingdom to Martinique to France. Can you explain to us a bit about the VAT implications, or if it's something that you can
So,
answer?
so no problem. So either with French foreign territories, it is slightly nuanced. So we did a shipment quite recently for a client that was moving goods into French Guiana in South America, and each of the, I would say, foreign territories have their own unique customs clearance processes. So I stand to correction on this, and please do not quote me, but I believe moving goods into Reunion is the same as moving goods into mainland France, whereas moving goods into Martinique or French Guiana, there are specific territory requirements that need to be fulfilled. So I can double check this for you post webinar if you would like the exact answer, but I believe you would probably need to facilitate the movement directly through Martinique because there would be no benefit of going via France.
Perfect. Thank you very much. One of the people looking at us said we have a deferment account and we use postponed VAT together with a European EORI. Is there anything else we need? My understanding is that that should be
No, they're very well informed, which is a pleasure. So
a good accountant.
a good account, correct.
Perfect. Another one that this is, I think it's a very important one. Can we use a Northern Ireland EORI number or an NI EORI for other European countries?
The long and short answer is yes.
Okay.
It can be used. However, there are certain requirements that need to be done with it. So you need to notify if you're going to link it, for example, to a European EORI, a European VAT registration, the VAT, the specific office within the Dutch tax office, for example, needs to be notified that you're going to be using an XI EORI in order to facilitate the importation of goods. So it can be done. It just is slightly more nuanced, but once set up correctly, it's not an issue.
Thank you very much. I've got a question that is mostly about the implications of actually the responsibilities of Incoterms. So I will try to answer this one. So can you briefly explain what were the differences in DAP, DDP, and the DDU? I assume the person wanted to say shipments in terms of who pays the VAT. So Incoterms are they are trading terms that are dictating where the goods are considered delivered and who is responsible for what during that shipment. DDP means that the seller is responsible for everything, including the clearance of the goods for importation, and that means paying the duty, paying the VAT, and doing the customs declaration, basically being the importer of records. So this is DDP. And in order to do that in European Union, you'll need to be registered with an European Union EORI. You should have a VAT registration number there, a tax representative, even a deferred VAT approval. So all of those in order to recover those money. So every time when you sell DDP, take in consideration the VAT aspects. Do you have everything in place to get the money back from that country where you are sending the goods? DAP can be you can use DAP instead of DDP, and for delivery at place, the responsibility for the importation, so clearing the goods for importation, this is the responsibility of the buyer. So the buyer in European Union will be responsible to complete an import declaration, or a third party will do it for them. Also, to be charged for VAT and import duties if applicable. So this is the main difference between DAP and DDP. DDU, it's an old one and is not quite accurate to use DDU, but there are still agreements between the companies. So remember, DDP only when you are 100% sure that you understand the VAT implications. If you don't, you have Alessio, you have us to ask us questions. Use DAP instead. I hope this answers the question. We are registered in United Kingdom. We have an EORI for both UK and Northern Ireland. Can we use the Northern Ireland EORI as European importer of records? You just asked for this one?
Yeah, so that's done.
Let's see. This is a scenario. It's again about the goods going through France at Martinique or Reunion as per customers' inquiry. This is what I would suggest is just to email us, because I see here
Slightly
certain
nuanced.
aspects that are not, because every time when you get goods in a certain country, they are in Europe, they are calling them regimes, or they are customs procedure codes or just procedure codes. We don't know how the goods were imported in France. Were they in transit? Were they in customs warehousing? Or let's please email us. You have the emails. You have the email from me. You will get it slightly later with the presentation, which includes Alessio's email as well. Alessio, is that all right with you for people to contact
That's
you
perfect.
directly?
Thank you.
Perfect.
That's perfect.
But all right, this is a very interesting one. Can you have an EORI VAT number in Netherlands, for example, but ship to any other European Union country and use the register details in Netherlands to allow you to be able to claim back the VAT? My understanding that, can you explain actually, the question would be for you, can you briefly explain VAT triangulation and including the perspective where the UK entity has a VAT number in one of the European Union countries?
So this isn't theoretically triangulation, but what it is that in Europe, you can only have one EORI number. Basically, what would occur is that, let's say now you are a German business and you've got a German EORI number. You can use your German EORI number to clear goods into the Netherlands, but you won't be able to claim back that import VAT in Germany, even though you've got a German VAT number, if you don't have a Dutch VAT number, because you can only claim back the VAT in the country where the clearance has taken place. Now, in your specific scenario, is that you could have a French VAT number and customs clear goods via the Netherlands, or you could have a Dutch VAT number and customs clear goods via France. So the origin of where you got your EORI registration is irrelevant. A European EORI number can be used in any European country. But the more pertinent question to what you're asking is that in order to reclaim back VAT when importing goods directly into a country, is you need to have the VAT number registration of that specific country in order to be able to reclaim it. So if you're importing goods via the Netherlands, you need to be able to have a VAT number, a VAT registration in the Netherlands to be able to reclaim it. The same for France. Now, the reason why we're only speaking about the Netherlands and France is because they are the two primary countries in Europe that allow for indirect representation, meaning that you do not need to have a physical business set up in said country in order to import goods into that country. Whereas in countries like Germany, Spain, Italy, Austria, I would say arguably most European countries, in order to import goods into that country, you need to have a physical establishment of some shape, in some shape or form.
Thank you, Alessio. There is another question that I think you just answered. We are registered in the UK with the VAT and EORI. How can we get that reverse charge 0% VAT? Is there any other registration required? You will need to register in European Union. This is what Alessio just said. So
Correct.
yes, and somebody else asked us if the people watching us can send us future questions from
Most
both
certainly.
of us. Yes, certainly. And I think this is the last one that I can see here. How do we have VAT deferment when shipping from United Kingdom to European Union? This person has a VAT number, has a deferment account number in United Kingdom. Can you explain a bit about the deferment, VAT deferment in European Union? Because in United Kingdom, it's just an account that you can use to defer any import charges. How does it work in European Union? Can you give us some more words?
If I understand the context of the question correctly, so deferments in the Netherlands are not automatically applied to your VAT number and to your import account. Whereas in France, if you're making onward supply, so in other words, you're selling the goods that you're importing, the import VAT is ultimately deferred. But it's an important distinction to recognize that it is only the VAT value that is deferred. So if there are duties or other, let's say, any form of excise tariff or duty applied to the import of that good, the duties and the tariff are not reclaimable. And that's an important distinction. There are special dispensations, for example, if you are an NPO or if it's goods for medical or religious purposes that are being imported in the country for research, that you can get the duties basically expunged or removed from the importation of the goods. But I would say, the majority of instances, duties have to be paid and they are not reclaimable. And a deferment in the European context does not remove the duties from the import costs, only the import VAT, because it's considered a commercial taxation that only the end consumer needs to foot the bill for.
It's basically passed from
Correct.
one to another. In United Kingdom, the deferment account is a method of payment for import taxes, including duty and VAT. And basically, when you declare this method of payment on your imports, whatever you import from the first of the month until the next of the month, the payment will be deferred until a later date, and it will be taken from your deferment account, for which you should have a direct debit with HMRC directly to put money in there, and you might need to have what is it called? Okay, bank guarantee. You will need a guarantee in place from the bank that you have those money to pay when you are importing. And if you have import taxes of up to £10,000 every month, you might apply for a waiver for that guarantee. But UK import VAT, if you are VAT registered, you might be able to use postpone VAT as method of payment, which will postpone the obligation of registering that VAT or paying that VAT until the next VAT return that you are completing, which is most of the times is later than the fixed date of 15 of each month when you have to pay for the VAT deferment, or for the deferment account, because it can be used for the duty. I hope this clarifies the UK deferment account number, and Alessio told you about the European Union one. Last call for a last question. And if you don't have any last questions, I can tell you that next week on 11th of March, I will be present at this event that we are doing together with UK Export Finance. And please send us an email if you would like to participate to this. Alessio and I, we are working together those days on the dates of a training that we want to do for focusing on VAT. And Alessio, I assume that we will introduce VAT triangulation as well, and what is required for moving goods from here to Europe from a VAT perspective. Please send us an email, either Alessio or myself, if you are interested to participate to this, and also if there is something specific that you want to be included in that training, because I assume that this will be a half-day training, Alessio. What do you think?
Yes, I would imagine it'd be anywhere between 3 to 5 hours, around there somewhere.
Yeah.
Right?
So please send us your emails if you are interested to participate, and also if there is something that you want to be included, because we want to deliver this training focused on the actual needs of the companies, not just a generic and that's it. Okay, I see that there is an extra question. It's in the Q&A. In your scenario with the two companies, while Nova Strength will import goods to Nova Strength Netherlands Jori and Netherlands VAT, the further sale to the actual buyer in the Netherlands is based on a different NL to NL client invoice.
So that is where we apply the reverse charge. So because you've imported it to a Dutch entity, and I'll say that hypothetically because the UK business has a Dutch VAT registration, the onward supply, so the sale of those goods is to another Dutch business, and because that business is also VAT registered, the sale of those goods does not require the addition of an additional 21% sales VAT, because the transaction is between two VAT registered businesses, which basically makes the sales VAT zero, because it's a business to business transaction and the VAT is basically just passed from one business to the next.
Perfect. Thank you very much, Alessio. I think we are done for today. We are 7-8 minutes longer than we planned, but this is because we had a lot of questions. People are saying that it was useful. This is what I can say as well, Alessio. I learned a lot. Thank you very much for offering us so much knowledge. Thank you, Alessio.
Thank you. Thank you very much, and thank you,
I also want to thank you all the people that managed to stay with us until the end with this sometimes boring subject, because customs and VAT sometimes can be boring for others. For us, it's not. So thank you very much, Alessio.
Fantastic. Thank you very much, Melon, and thank you very much, everyone. Have a great day further.
Thank you. Thank you, everyone.